2019 Market Watchers Live Show with your hosts, Tom Boley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. All right, let's take a look at what's going on in the market today. We are seeing some selling. We had a big reversal yesterday, and the selling momentum is continuing today. Currently, the Dow Jones Industrial Average down 164 points, the S&P 500 down 16, the NASDAQ down 38, and the Russell 2000, which really had been lagging, also leading to the downside, down more than 17 points today. 10-year Treasury yield continues to drift lower as we head into the Fed announcement in just a couple of hours. 10-year Treasury yield currently at 2.585%, getting close to that January low, which was down at 2.55%. Volatility index, as you might suspect, is picking up, still low, down just over the 14 level, but it is beginning to rise. And as fear builds, that generally is not a good thing for the stock market. Energy leading to the upside, crude oil getting close to $60 a barrel. And as a result, we are seeing energy lead to the upside. Exploration and production, one of the key areas in that space, performing well today. You can see it up close to 1% and trying to break above some key resistance in the mid 650s. Communication services at this point flat, but on a relative basis actually performing pretty well given the drop in the overall major indices. Internet stocks doing pretty well. Facebook rebounding off of its recent lows. Twitter also trying to make a short-term breakout. As you can see, after that gap down back in early February, it has not been able to close above 32. It's trying to do that today. General Mills came out with a great report. You wouldn't think this, but General Mills is up close to 40% since that December low. They came out with very strong results, easily beating expectations, raising guidance, and General Mills looks pretty good as we head for the next earnings season next quarter. All right, Erin, welcome. It is Wednesday, hump day, and it looks like the market's struggling a little bit today.
Yeah, I think it's finally going to do that pullback. You know, it looks like it started it yesterday, and I figured that, you know, we would get a rally all the way into next week because we both came into the week bearish. So at least we're getting a little bit of reprieve here as far as what we thought was going to happen.
Yeah, you know, yesterday when I went through a lot of those charts, there are just negative divergences everywhere in the market. And of course, that never guarantees us anything, but it does at least tell us that based on this big rally that we've had off of the December low, that we probably could use a pullback and some consolidation. So this maybe is the start of that. We'll see. But I find it at least encouraging that we are pulling back. We were overbought. And like I said, a lot of these highs that we're seeing are being accompanied by lower PPOs, MACDs, PMOs, and so forth. And I think that is an indication that maybe we've just gone a little bit too far, too fast.
Yep, I agree with you.
All right, we do have a special guest back with us today, Dave Keller. He was joining us again today. He's going to go through his routine in the market. I think that will be a great segment. Welcome back, Dave.
Thanks, Tom. Thanks, Erin. Good to be with you guys. Yes, in conversation with a number of StockCharts users over time, I've found there's sort of often a sporadic way that we approach this, powerful information tool. So I wanted to kind of talk through how to structure a morning coffee routine using, the tools that we have available, but in a thoughtful way from a behavioral perspective. So, trying to make sure that we're setting ourselves up for making good decisions at the end of the day.
Yeah, well, it's always a good idea to have some discipline in the way we approach the market and the way we approach everything. So I think that'll be a very timely subject.
That's right.
Stick around. We're going to have you back here in about 15 minutes, if that's all right.
Sounds good, guys.
Perfect. All right, Erin, take it away.
All right. What's coming up on our schedule? And as you can see, Julius DeKempener, he will talk RRG, of course, tomorrow. I will be doing my workshop next week on reverse divergences, as well as a refresher on divergences in general. Doug Bush from ChartSmarter is going to be with us on Wednesday of next week. So exciting week coming up. Today's agenda is also exciting. Dave Keller, just as he said, will be showing us his morning coffee routine. The first 10 and 10 symbol is going to be AMC Entertainment. And our final segment, Tom and I are going to look at what we call momentum sleepers. So stick around for that one. But let's go ahead and get the party started. Technical news and headlines for you, Tom.
All right. Yeah, I'm just going to jump right into the 10-year Treasury yield and take a look at what's going on there because There really wasn't anything in terms of economic news out today. We do have the Fed meeting in about 2 hours. They're going to give their announcement in about 2 hours. They've been meeting. This is the second day of their meeting. So I think traders are on edge a little bit. I think that's part of what's going on. We've had such a huge run up. I think we're seeing some traders lock in profits in the stock market, but they continue to buy in the treasury market. And as they buy and treasury prices go up, we see that yield continuing to decline. And this really, again, I've said this over and over again, but it just doesn't paint a great picture when the bond market looks ahead. If it's seeing, really good growth, we should be seeing these yields moving higher, and that's not what we're seeing. So I think that's maybe adding a little bit to the nervousness in the stock market as we await the FOMC meeting and their policy statement. Taking a look at some of the earnings reports, and this is kind of interesting because when you look at General Mills, a company like General Mills, they have reported really good numbers, and they're actually trading and been trading like a really strong high growth company. They came out with their earnings. They came in 83 cents, the market only expecting 69 cents. Certainly that's a pretty darn good beat. And when you look at their revenues, they also came in pretty strong on the revenue side at 4.2 billion versus 4.18 billion. And then they guided fiscal year 20 earnings per share higher. So really good report by General Mills. We'll take a look at that chart here in just 1 second. But you can see on your screen, General Mills had a really good report there toward the bottom. Unfortunately, Fedex is on the other side. Fedex missed on the top line, missed on the bottom line, and lowered their guidance. But so far, Fedex trying to hold on to some support. And then you can see a few other smaller companies there, all coming in with decent numbers. FNV, Franco-Nevada, did come up just slightly short on their bottom line. After the bell, big one coming up in the semi space. We've got Micron reporting tonight. So you'll want to keep an eye on that. We've had a really strong run in the semis, and I'm sure they would certainly like to see one more of the peer within that peer group. Another one of the companies come through with a really solid report. So that'll be worth watching after the close today. All right, let's pull up General Mills. I want to see that chart and show you what's going on here. I like to follow my relative charts, and I think it was certainly pointing to a good report out of General Mills. You can see General Mills, here is the rally. We were at $36. If the stock gets up a little above $50, that would be a 40% move in 3 months on General Mills. And this is a consumer staple. This is not, a high growth software company. So to see this kind of a move, I think was very encouraging going into the report. You can see that the food products group overall was not breaking to new highs. So over the last 3 months, look at the relative strength in General Mills heading into its earnings report. So we shouldn't be shocked when we see this kind of money rotating into the stock, and then they come out with the great earnings. On a relative basis, again, food products versus the S&P 500, this has been one of the worst areas. We're near a 52-week low on a relative strength basis, food products versus the S&P 500. And yet, one of the component stocks, General Mills, you can see outperforming the S&P by a mile over the last 3 months. So I think, again, this is another indication of why I like to follow these relative charts. I think this is really important. Take a look at FedEx. So FedEx, while the market's been trying to get up near its recent highs, look what FedEx has been doing. Continues drifting lower, huge move down in December with its earnings, came back up, essentially just kind of filled the gap. And with this weak report today, gapping back down. I do find the reaction today somewhat encouraging, though, as long as it continues to hold this 170 area, because there's a lot of bad news already built into FedEx. And again, you can look at the FedEx relative to its peers. It had been under tremendous pressure for several months. Same thing versus the S&P 500, and the group has not been strong. So you combine all of that, a weak industry group, and then one of the weaker stocks within that industry group. And what do you get? You get revenues of $17 billion versus $17.7 expected, $3.03 in earnings, $3.10 expected, and they guided their fiscal year 19 earnings per share lower. But good news so far is that we are holding on to that 170 level. We don't want to see FedEx start to roll back over again, lose that price support, because I think that would start to point to a retest of that 150 area, something to watch on the charts as we move forward. A couple of other reports that came out. TME, this is 10 Cents Music, or 10 Cent Music Entertainment. Actually, I'm going to pull this up on a regular chart first because I think there may have been a negative divergence. Yes, there was. Okay, so we're moving up. This is a company that had gone from $12 up to $20 at yesterday's high. We're talking about almost a 70% move in 2 months. So a lot of good things were already built in. They beat on their top line, they beat on their bottom line. But, and this is what worries me about the overall market, look at the higher price, the negative divergence with the lower PPO, and then look at that reversal yesterday. That's a dark cloud cover candle, which is a reversing candle off of this uptrend. And it also failed to hold the breakout level. When I get a negative divergence, now again, we're going into earnings, so I probably would not have traded this, but historically, this is what I look for when I get a reversal like this with a negative divergence. I expect additional weakness. I think Tencent probably is heading down to at least test the area of its breakout here at about 16 and a quarter, and that would test its 50-day moving average and probably move that PPO back down closer to a centerline reset. FNV, I mentioned this one. They came up a little short on their earnings per share. They also came up short on revenues. I did not see guidance, but you can see the stock breaking down below this double bottom, which is not good, but it is coming back off of the low. If it could get back up, rally close to the open, I would feel a little bit better about this chart technically. If it finishes near the low, I think it's got some problems because you can already see it's going to have very heavy volume today. So you don't want a heavy volume breakdown. SMAR, this is Smart Sheet. This one actually looks pretty good. And I'm going to pull up the relative chart on this one as well. And you can see that it is in the software space. So you got obviously software. We've talked so much about how strong this group has been. It's been one of the leaders. And you're looking at Smart Sheet, which going into this report over the last 2.5 months had risen from 22.5 to 45. So it had doubled going into the report. So again, when I look at that, I'm thinking they've been telling Wall Street things are good. Wall Street's buying the stock. That's why we're seeing such awesome relative performance. And sure enough, they came out, they beat on their top line, they beat on their bottom line. They were expecting a loss of 14 cents. They came in at 7 cents. And this is how you want to see your relative charts line up. You want the peer group rising against the S&P. You want the stock rising against the S&P. You want the stock rising against its peer group. And you want the peer group actually making breakouts along with the individual stock. I think this is a stock that's showing tremendous relative strength. And although it probably a lot of it is built in, and I do think with this black candle, if this holds on heavy volume, we're probably looking at some more weakness in the near term. But I believe that's likely to set up a nice opportunity on the stock. I suspect that we're going to get a 20-day test, which is at 40. We might go a little bit below, possibly even as low as these recent lows. I don't think we'll go down quite that far, but I would be thinking about using weakness as an opportunity here. Okay, Erin, you got upgrades and downgrades. What do you have for us today?
Yes, indeed. Very long list in terms of upgrades and downgrades, really on both sides. So let's get started. All right, I'm going to start off with CREE. CREE. And today, JMP Securities upgraded it from a market perform to a market outperform with a $74 target. I looked at the daily chart, and I'll show that to you just really briefly, but I thought it was way more interesting on the weekly chart. But you could see a pretty strong daily chart, just got a buy signal. You notice that the PMO has been rather flat during this rally, and that's not something to necessarily worry about too much, mainly because it tells you that the acceleration on the way up was pretty even. We really didn't increase, we didn't really decrease that acceleration a whole lot on that rally. So seeing a flat PMO doesn't necessarily mean it's a bad thing. But as you can see, I had the feeling when I looked at this chart that we would be chasing it. But then when I looked at the weekly chart, I found it very interesting. I still think you need a pullback, but we had this area, we have this area of support back here from July, and you can see the upside potential. There's quite a bit here if we can get that continuation of the rally. But I would look for a little bit of a pullback here because we would be chasing at this point 1.25% move so far this week. Let's go to our next one. Capital One Upgraded Oasis Petroleum. I've noticed there were a lot of energy stocks that were in the upgrade category, as well as in the downgrade category, unfortunately. But I think Oasis Petroleum is really, I like the upgrade on this one. We do have a declining trend channel, which is not the best to see, but we do have the PMO buy signal came in, and you can see that the OBV, the volume on that rally was strong. So seeing a positive or a reverse divergence right here with the OBV, you could see the higher volume as we're going through this decline. I'm looking for a breakout and a move to at least $7, which you can see would also coincide with the support level that we had back here in November. So I think Oasis Petroleum looks pretty good. Texas Roadhouse was also upgraded today. Stevens upgraded it from an equal weight to an overweight with a $70 target. And, you know, at first I thought this looked like a pretty good upgrade. You know that the PMO, though, notice that right now is turned down below its signal line. And even on the upgrade, we are getting a 1.25% pullback. Now, that could be a good thing, because we did just look at CRE and it needs the pullback. And we might actually be getting it here on Texas Roadhouse. Watch that area of support back here at $59. All right, let's move on to our next one. And that would be Vodafone. This one was also upgraded today by Macquarie from a neutral to an outperform. I think this one's looking really healthy. You can see that short-term breakout from that trading zone that we were looking at, mostly going between $17.50 and $19. And we've now gotten above that $19 range. Next area of overhead resistance is all the way up here at $20.50. So this could be a pretty decent move here off of this buy signal in the PMO, and it's now finally reached positive territory again. So I thought Vodafone looked pretty interesting on the upgrade. Whiting Petroleum was also upgraded today, another energy stock. I like this breakout. If you want to look here in the thumbnail, you could make a case for a reverse head and shoulders off of that gap down, which would mean, you know, if we've got the breakout right now from the neckline, it's not a decisive. Well, actually, it looks like it could be considered decisive with a 7% gain today. But I like that buy signal, and overhead resistance, not there until about $30 in my estimation. All right, let's do our final, and that will be a downgrade right here. Rockwell Automation was downgraded today, and I think this was a good choice. I think that it still has further to decline. Look at this almost textbook double top coming off of this rally that we had from the December lows. And, you know, we already got the PMO sell signal, and even off of this rally, when we came up and made that the second part of the double top, we never got that PMO even close to having a positive crossover. So to me, it was already showing that negative divergence as far as the PMO is concerned. Excuse me. So now I'm looking for a breakdown below that area, the confirmation line. And if you do the measurement, it would put you pretty much right there at 160, looks like 162.50. So I would be looking for some more downside here on Rockwell Automation. That's all I had for our upgrades and downgrades. Here is the listing, a couple of the interesting ones. Nevro was upgraded by three different groups, agencies, and mainly because I guess they replaced their CEO. So I thought that one was pretty interesting. But Dollar Tree, you can see on there, all Yum Brands was downgraded again today. Wendy's downgraded. I will have this slide up in the Market Watchers Live recap at the end of the day if you wanted to look at these more closely. All right, David. Time to bring you in to talk about your morning coffee routine. I can definitely say that coffee is part of my morning routine, but I don't know how much more of that routine I have in comparison to what you do. So looking forward to hearing about it.
Absolutely, and it's worth noting with all the negative divergences that you guys had pointed out earlier, Tom and Erin, that the market has rallied significantly since you guys started the show. So your very presence is a bullish influence, I think, for the markets. But no, it's a pleasure to be with you guys, and the idea for what I wanted to share with you today came from a number of conversations I've had with my own clients at my firm. And a lot of times what we try to do is deconstruct their routines, because a lot of times, behavioral biases and the way we're wired to make, in some ways, poor decisions with our investments, so many times can be shown to be a factor of how we've structured our days, how we've structured our process. And, if you don't have the right process for what you're trying to accomplish, a lot of times, regardless of, you're setting yourself up for failure, basically. You're setting yourself up to make a bad decision because you're not setting up the right routine to get you in the right mindset. So what I wanted to do was just share some general thoughts, and then actually show you what my morning coffee routine is. After I get the coffee, I sit down. How do I get a sense of what I need to be aware of in terms of market awareness and understanding where the opportunities might be? So just to introduce it, I had written an article for the STA Journal, and the STA is the British Technical Analysis Association. It's been around for decades. And I wrote an article for their journal last year and titled it "A Student Pilot's Guide to Technical Analysis." And as some of you probably know from what I've written and have been a guest on the show, I've talked about learning to fly an airplane and how that can be so many times related back to investing and charts and visually analyzing things and having discipline and a process and so forth. And, I try to just summarize why it was such a good parallel for investing. And I think it'll help illustrate some of the points we're going to show this morning. And what I boiled it down to were there were three characteristics. There are three things you did as a pilot that you need to do as an investor. And the first is be prepared. The second is be aware. And the third is to be ready. And each one of those, very, very quickly, be prepared means you have to have a good game plan. And, Arthur Hill on StockCharts does such a great job of, reminding people, plan your trade and trade your plan, and, have a good game plan before you pull the trigger on anything. And so many times we get caught up in the fear, the emotional drivers, what compels us to want to take a position, as opposed to having a clear, disciplined process ahead of time. So the very first thing you need to do is be prepared. And I think how you structure your mornings, how you actually start the day in terms of analyzing the markets and where they're at, can help you be prepared, or it can be a poor preparation if you do it incorrectly. The second thing is be aware, and what that means, the name of my firm, Sierra Alpha, comes from situational awareness, which is having an awareness of what's going on outside of the cockpit and understanding the environment around you. And as investors, it's so important to pay attention to our environment, understand what's working and what isn't. So, Tom, your charts earlier, looking at all the relative strength characteristics of some of those charts, of some of those stocks, I think is so vital. And I find so many people make that simplistic error of just not paying attention to the relative positioning of different stocks. And as a result, you might have great analysis on a particular stock, but you're looking at the wrong stock in the first place. And what relative strength tells you is where the opportunity is. Is this the type of name that is going to, potentially, give me opportunity going forward? So the second item is to be aware, understanding what's happening. And again, charts I found are one of the best ways to have a market awareness. And I'll show you some of the ways that I do that. And then the third item after the first two is to be ready. And so part of understanding, part of having a good market awareness is seeing as things change, paying attention to key signals, key models, key indicators that are going to help you, have a good probabilistic sense of where the market could be headed and how you want to be positioned related to that. And again, with charts, with things like the market summary, the chart summary, the relative rotation graphs, you can get a sense of, where there's movement, where there are inflection points, where there are opportunities, and then you are then ready to take action. So that's the way I would think about sort of your morning coffee routine. How is that routine, the routine with which you start to look at charts first thing in the morning? How is that helping you to fulfill those three objectives: to be prepared, to be aware, and to be ready? And I would encourage you as we go through to think about your own routine. Think about what you look at first and what is the process, the order with which you look at things. And I'll try to explain why the order is so important as I go through my own example. And just a couple quick comments before I sort of get to my own charts. The first is we did set up a poll on the side of the screen, which I hope you'll take a moment to look. It's just paying attention to the S&P 500, and I'm very curious as to what people think will be next for the S&P. So I sort of gave you three choices. The S&P was around 28.25, went down to around 28.16 or so this morning. Right now it's settling in around 28.20. And it's where do you think the S&P will go next? What will it reach first? Will it reach the October 2018 high? That's your first choice, which would be, up in the 2,900 odd range. Will it retest the earlier March low and break that down to 2,700, which would be option number 2? We go lower first. And then option 3 is we stay within that range from around 2,700, around 2,950, and in the next 3 to 6 months, meaning we're really range bound within that extreme. So if you haven't done so already, I'd love for you to go in and just answer that poll, and then we'll refer back to it at the end of the presentation here. I'd also point out, I'd love, if other presenters, what I love about, watching Market Watchers Live is seeing, Tom and Erin, seeing how you actually show your login, show your charts, and I get plenty of ideas just seeing how you lay things out and how you pay attention to them. So I hope my other fellow contributors can do that, because I think the more you see from people that are very familiar with a tool like this, I think the more you're able to take advantage of it. So I hope you're able to see that from some of the other presenters as well. So what I'm showing you now, I'm showing you my own login and showing you the market summary page. And the first couple charts are, maybe what your process kind of looks like. I'm not sure. And I know everyone's different. Your time horizon is different. How you're trying to win the game, your goals, your investment horizon, your universe of securities that you're picking, they could all be very different, each of you, and different from my own. But the question is just answer that question first. What are you trying to do? And then make sure your morning routine is setting you up to make good decisions in that environment. So what a lot of people do, I've seen when I work with them and we look at stock charts together, they start at a summary. They start with what's happening. So if you look at this, again, it's great information, but it is very short-term oriented. So immediately I'm seeing that most of the broad U.S. Equity indexes are down, again, midday on a Wednesday. I can then glance down and see utilities are the one index that's up, and everything else is down, with transport's really the weakest, with FedEx and others that Tom mentioned earlier. Energy is leading, financials are lagging, and so forth as I go down through here. So that's fine because it's good information. But again, what am I trying to do? Now, put yourself in my shoes for a moment. I'm more of a long-term investor. I'm looking 3, 6, 12 months down the road, trying to understand more of the long-term structural trends. So one of the worst things I could do is start with a very short-term oriented look, because I'm very much gearing myself, I'm priming myself to the current short-term intraday movements. And I shouldn't be structuring a long-term process based on, a couple hours of trading on a Wednesday in March. Now, the next thing you might do, and I hope not, is go to a very short-term chart. So, now that I'm looking at the last 3 days here on a 5-minute chart with the RSI at the top, with the MACD at the bottom, and I'm just looking at the last couple of days. So now I see that the S&P is down. I might want to see how that looks relative to the last couple of days, and I'm getting the short-term perspective. And again, both of those are fine charts to look at if you are really gearing yourself toward that time frame. But this process I'm showing you is very disconnected from how I'm trying to win the game, how I'm actually trying to make good decisions. So I would really encourage you, as I go through, I'm going to start with my own process and explain why I have things set up a certain way. And then again, I'd encourage you to think about your own process, how you have things set up, and are just a couple tweaks that you could make in your own login, in your own process, to set yourself up to make better decisions. So again, with the time frame I'm thinking of, which is looking 3, 6, 12 months down the road, I need to be starting looking at a pretty long-term stretch of time, because I want to prime myself to the long-term trend. I want to understand where things have come from and then focus in on where I should be going next. So we're now getting into my actual process. The first chart I look at every morning is a weekly chart looking back about 7 years of data. I'm going back to the 2012 low, seeing the 2015-16 correction here, and then seeing where we've gone to the first quarter of 2019, where we're at today. And again, it's not focused on the short-term movement. I'm not paying a ton of attention to the current price bar. I'm looking more at the overall trend. So, my general thesis on the markets has been we're in a secular uptrend, meaning, broadly speaking, we're in, depending on where you think it started in 2009 at the low, or maybe 2013 where we broke to new highs. We're 6 to 10 years into this bullish market. So, thinking about that long-term trend is the very first thing I'm starting with. The second thing then is, what is the cyclical trend? What is that intermediate term? And in my mind, we've been in a bearish cyclical trend with, after a period of clear accumulation, we've had this sort of consolidation pattern over the last year, more range bound, higher highs, lower lows, a broadening pattern, but overall directionally, I would argue sideways to down. So overall, that's rather negative. But on the tactical side, the short-term side, I can see that the market's clearly been appreciating since the December lows. But the goal here is to start with the big picture. So if I'm trying to understand the long-term trend, I need to start by looking at the long-term trend itself. Then I'm looking at the daily chart on the S&P 500 and just focusing on the short-term price action within that trend. So now that I understand my own view of the long-term trend, I then can look at some of the short-term trends and actually see where we're headed. Here I see some of the things like the initial thrust off the Christmas Eve low end of last year. If you take the corrective period we had at the end of January and project that same wave forward, that was sort of the objective of around 2,800, which is why these current levels make so much sense. And I'm also seeing, if we would sell off or correct a little bit, I have some general sense of where I might expect some support here around 27.25, maybe the 50-day moving average in a similar level. I'm also seeing the bearish divergence that Tom mentioned on a number of charts. You see it on the S&P chart, arguably as well, with a higher high yesterday and a potentially lower peak here in the RSI. From then, I'm still, if you think about it, trying to stay relatively long term. So in my mind, I have a number of more longer term trend following models that I follow. And again, many people have some longer term moving average combination they might pay attention to. And for me, again, this isn't an output of my process, it's an input into my process. So it's part of the mosaic that I would paint to understand an overall market perspective. So in this case, excuse me, I'm looking at the 21 and 34 week exponential moving averages. And here I have the PPO just to show the difference between the two of them. And I can see that they crossed up about a month ago as the the market obviously rallied so quickly out of the lows. And now I can see that that very simplistic trend following model is more on the bullish side, telling me that the trend overall has been positive recently, which makes sense. I then have a series of other models looking at mid caps, small caps, and also global markets, just to get a sense overall. Again, if I know nothing else, what's the overall basic trend with each one of those? Then I start to get into some of the more particular indexes, right? And again, I'm not yet looking at what the market is doing today. I'm just looking at the long-term trend. And I think that's an important point. So many of us start with the current intraday movement and we think, okay, the S&P's up, it's down 50 bips. Okay, what does that mean? And from my perspective, even if you're short-term, that should be toward the end of your process, not at the beginning. So you want to put that toward the end. Once you have a good sense of the trend, a good sense of where we're coming from, then you have earned the right to look at where we're at today. So now what I'm starting to do is looking at the S&P versus other broad benchmarks, Dow versus transports, to look at sort of a simplistic Dow theory read. Here I can see that, the Dow transports are arguably starting to, potentially get to the point where they're breaking to new swing lows. That would be sort of a negative from a Dow theory perspective. I can look at some of the different cap tiers, large versus mid versus small, and see if there's any differentiation here. So here, small caps well below the 200-day moving average, testing the 50-day from above. Compare that to the S&P 100, the mega cap index, well above both of those moving averages. So seeing that divergence between large cap, mega cap to small cap is something I might want to look at. And in some of these, the way that I have mine set up, and again, it's not perfect. This is just what I've done. I tend to use a lot of the candle glance charts and then zoom in and out to some of these. So with the mid cap index, for example, I might want to jump in and look at that chart in a little more detail. And then I have some notations I might want to draw with trend lines and key levels or something as a sort of a workbook, a reminder of what I want to pay attention to. But it's also worth noting that comparative charts have a great place here as well. So now instead of just looking at the prices, I'm looking at the relative movements of the S&P in black versus some of the other cap tiers, mid, small, and micro caps. So now that divergence makes even more sense, right? I can see the S&P 500 making a higher closing high in this last couple of days, where I can see small, mid, micro all have made lower closes over that period. So we're starting to get some dispersion even within U.S. market cap ranges, suggesting potentially some internal weakness. Then again, and again, this is not to tell you what your process should be, but just to illustrate what my process is, and hopefully get you thinking about how you might maybe just make a couple brief improvements to your own thinking or how you have things set up. I'm then looking at broad global regions and then at individual country indexes, things like China, Brazil, India, places where we've seen movement and seen opportunity. What are those relative movements to one another? And here, when you get to this level, you can start to see some real differentiation between different countries and different setups. And again, I also have some of the comparative charts set up here to show me, in this case, the US leading out of the December lows, with EFA, EM, frontier markets all lagging behind. Again, this is just returns over that period. Continuing on here, then I like to look at intermarket analysis. So Tom had mentioned interest rates, mentioned fixed income holding up so well. And here you can see the aggregate index, liquid ETF, the high yield ETF, excuse me, all breaking to new highs, while equities have maybe lightened up a little bit. You can see commodities starting to appreciate, potentially breaking to new highs. And now we can see it relative to the equity markets we've already looked at. Then what I do is I switch and start to look at some market internals. So I try to understand sort of that second layer below the market movements. What can I look at that would either confirm or deny what I've seen from a broad technical perspective? So for example, under a chart list that I have called breadth indicators, I'm looking at the percent of stocks on the NYSE and also the S&P 500 above their 200-day moving average. Overall, what's the participation? If I do see weakness in the market, are these holding up, telling you that the average stock is still holding up okay? That's one thing I might want to look at. Here I'm looking at advancers, decliners. So seeing if we do, in the last couple days, excuse me, a little bit of distribution. So we're seeing the increase in decliners versus advancers. This is a really interesting one as well, looking at new highs and lows. So now as I see the market appreciating here, look at the number of new highs that we've consistently seen. Now, this visual is actually skewed a great deal because of so many new lows that we had toward the end of December leading into that December low. But the fact that we've had very few new lows tells you that, again, most stocks are still holding up pretty well. And there's plenty of new highs out there, in technology and other places that are moving higher. Once this starts to get increasing, once I start to see stocks making new lows, that tells you that you're starting to see that distribution. We haven't seen it yet, but that might be one of the places where I would look for that. I then continue through to look at sentiment, things like the VIX, volatility, put-call ratios, the AAII sentiment readings. Then I get into a series of ratios, which can be really, really interesting. There was a great chain on Twitter last week, if I remember right, where someone had asked a number of people what their sort of go-to 5 charts would be. If you had 5 charts to get a read on the overall market, what would they be? And I'd encourage you to look that up. You can, if you look at my Twitter handle, DKeller CMT, you'll find it linked on there because I participated, but a number of people did, including a number of the StockCharts contributors, and it was really cool to see all the similarities. There are a number of things that were pretty consistent, but also a lot of really unique new ideas that I got from that. But these are some of the ratios that I use to get a read on the longer term trend. One is offense versus defense, consumer discretionary versus staples. And if you see a relative movement one way or the other, this is actually held up pretty well on the consumer discretionary side. If you would see this breakdown, you saw the chart of General Mills earlier. I mean, there are a number of charts within staples that actually look pretty constructive. So if you see more names look like that breaking to new highs, that could actually cause this ratio to turn lower, which would suggest more defensiveness. Going down here with other ratios, I'm looking at the relative performance of semiconductors. That tends to increase during a market appreciation, an up market. So I want to see if that's going to continue. And then I'm also looking at momentum factor. I'm looking at the relative strength.
Hey, Dave.
Yeah.
I got a question for you. Maybe you can get some water there for a second. I know earlier, this was one question I was kind of holding for you for the end. But you had pulled up a chart, I think, on many of the various indices, and you were showing a chart that had your 21 and 34 week EMAs, and I noticed that you set your PPO to that as well.
Right.
Is there a reason, or is there something that I was just curious as to the 21 and 34 week? How did you come up with those settings?
Yeah, it's a really good question. There are a number of people that do some combinations similar to this. So I've seen, a big Mo indicator, the 13 and 34 week moving averages. I've talked with Arthur Hill about doing the 10 and 40 week moving averages. For me, this is something I've used for years, and it came from a period where coming out of the lows in 2009, 2010, this indicator tended to do pretty well. It felt pretty good as a way of getting a sense of a general rotation from a bear phase to a bull phase. And so that's what I've stuck with. If you look at any of those combinations, they tend to give very similar signals. So, any long-term exponential averages like this are going to be pretty similar. So when they have given signals that are different, it's only a week or two off for the most part. So again, for me, this is just what I had found to be helpful at a certain point, and have just kept true with for years now.
So if you get like a crossover, is that a sign for you that the trend is ended, or is it just okay, this is a little bit of a warning that we're starting to see some of that momentum change and move in another direction? How do you use that data in your trading? I mean, as you're going through your morning routine and you start to see that 21 week moving average starting to slope over and head toward the 34, does it bother you when you get that crossover? Does it bother you if you get a crossover and the price breakdown? I mean, how do you evaluate that?
Yeah, really good question. So the way that I think of these trend following models is for me, they're not an output of the process, they're an input, right? So instead of putting money behind this model and saying, I want to own it when they cross up to the bullish side and I want to not own or be short when they cross down, for me, it's more of an input to the process. So the models are running in the background, trend following models. And I just want to, when this is bullish, when the, 21 week is above the 34 week, that tells me we're in the type of environment where I want to be adding to new positions. You want to generally be on the long side. You want to be hesitant to be in cash or be short because overall the trend is positive. And then when that reverses, when you see the breakdown, that tells you that we're in the type of environment where you don't want to be adding to a lot of new long positions. You want to be more defensive, more in cash, more on the sidelines if you can. Now, it is not an absolute thing. And that's why I make a point of saying that it's an input in the process. It's not the process on its own, because in any environment, there are going to be stocks making new highs and stocks making new lows. So for me, this is part of the top-down experience to sort of, what's the overall bias and how do I generally want to be positioned, but then open yourself up to the opportunities that could emerge. So, in a bull run like we've had off of the December lows, I would argue a stock like General Mills would probably be pretty far down your list of, new long ideas just based on where it is sector-wise and the type of business. But the stock's done very well. So opening yourself up for an opportunity in any environment, I think is pretty helpful. So for me, these sort of set the overall bias, but then I'm going to look at the individual charts of sectors, of stocks, of industries, and make the decisions based on those. But it's more, where am I going to generally tilt? And I would say that for me, I guess the evidence needs to be stronger if a model like this is more in a negative position, because it tells you that in general, we're in an environment where the average stock is down versus up. Does that make sense?
Yeah, it makes perfect sense. That was a great answer. There is another question that came in the room. Do you want me to save it till the end, or you want it now?
No, sure. Go ahead.
All right. The question was, you had talked earlier about the fact that the small caps were kind of rolling over beneath the moving averages, and you talked about the mega caps being above those moving averages and moving higher. So the question that came in from the room was, is this a sign? Is the weakness in small cap stocks a sign of maybe a bull market top? Does that bother you?
Very, very good question. And the short answer is yes. The long answer is as such. I mean, for me, I found, the chart itself is the main thing. So the main thing, the most important thing I want to pay attention to is the S&P 500 if I'm trying to get a read on stocks. And I want to make sure that that's where my analysis is focused. But having said that, looking at the sort of second level indicators, what I would call them, breadth, ways that would sort of confirm or deny what you're seeing from the broader picture. And I would maybe bucket some of the bearish divergences we've seen in the same category. These are things that give you a sense, if the trend is up, I want to be owning stocks. And if the trend is down, I would generally not want to. But looking for some of that, the divergences like that, I think can be really helpful color. So for me, if you look at the small cap chart, the fact that, the S&P is actually above this level. If you think of this as a chart of the S&P, it's already broken above, and it's, sort of above these previous highs that we had back in October, November, and it's sort of up in this range. But small caps are actually nowhere near it. They've pulled back so far, and they found really clear resistance around that level. So in a bullish market, in a long-term uptrend, this is the type of place where you expect to see some strength. You expect to see outperformance, not underperformance. So the fact that you're seeing weakness underneath the broad S&P 500, absolutely, I think suggests overall that's a sign of a weaker market, not a stronger market.
Okay, cool.
So the only other things I wanted to finish up with, just to sort of round off my own routine, and again, not to get into every piece that I do, but since we've gone through some of these ratios, I then look at the relative rotation graph to understand sector rotations, and again, some really interesting rotations. I saw Julius will be on next week. That'll be a really interesting one to see, because some fantastic rotations with communication services and consumer discretionary, which had been rotating so positively, all starting to turn down on the weekly RRG, which I think is an interesting theme to pay attention to. Then looking at sector charts, some industry charts, then looking at factors and understanding where you might find different types of stocks that are in leadership or laggership roles. And then finally, at the end of this, what I would point out, and again, I have a tab called brokerage, and please do not assume these are the stocks I own. I just put the FANG names in there as a holding place just so you could get an idea of it. But let's assume this is what your current holdings are. The point here is one of the very last things I look at are my current holdings. If you have that at the front of the list, if you have that at the beginning, you are opening yourself up to a number of behavioral biases, most notably confirmation bias, endowment effect, where you are looking at your own positions, and then you will try to gather evidence to justify why you have your current positions. The process for me has been starting with the long-term trend on the first couple tabs, then getting to some of the indicators that will help me characterize that trend or understand the direction and the trajectory of that trend. Then I'm looking at sectors and themes and some other things below that. After all that, and when I have a good sense of where the market is coming from and a sense of where I think it's headed, then I would look at my current positioning and see how that compares to what I've seen. So a lot of times we try to answer the questions in the wrong way. How should I be positioned? And then what does the market look like, basically? And you want to make sure that those are in the correct order. Start with what you're seeing, then look at how you're positioned and see if those are in agreement. And if not, then you now can start to see what have you been looking at before that might earn the right or might have earned the right to be in your portfolio, other than some of the things you might have been positioned on. Then from there, you can start looking at individual charts and go forth and sort of go through the rest of your day. But my goal with this presentation was really just to, in some ways walk you through my own process and how I've tried to structure it to help answer those three questions. For me, I'm looking longer term, and I'm trying to be prepared, to be aware, and to be ready. And a lot of times I've seen, unfortunately, people set up their process. They set up their morning routine in disagreement with those basic fundamental things that I think we need to pay attention to. So by making some little tweaks to how you go about your process of looking at charts, and particularly the order and how they're set up, I think you can incrementally add a better perspective and hopefully be better suited to make the right decisions for your portfolio. So thank you guys so much for having me on. I really appreciate it.
That's awesome. I do have one other question for you, Dave. Not going to let you get away without answering this one. Okay, so if you've got your own portfolio, so you've already gone through your routine, you're comfortable with the market, and now you're looking at your holdings. If you look at a stock that's in your portfolio and it's still rising, it still looks okay technically, but you're beginning to see it underperform some of the peers. For instance, say Google's going up, but you look at it relative to the internet, it begins to lose some of its relative strength.
Sure.
Do you hang with it as long as it remains okay on its absolute chart, or do you think about switching out when you begin to lose relative strength?
Really, really good question. And so, I would say that, the ideal chart, and not that Google's the ideal chart, but it's pretty close, to be honest with you, from a technical perspective. I mean, one concerning fact is that it's become overbought again, but overall, you have a clear uptrend in price. You have it making new relative highs versus the S&P. So in general, stocks making new highs that are outperforming and making new relative highs in general tends to be pretty good. Those tends to be pretty good charts that you overall would want to own rather than not own. So when you don't get that agreement, when you don't get that confirmation, when you see charts making new highs, but you see the relative performance going down, and that arguably is what you saw back here at the beginning of 2019. You saw, Google rallying out of the lows, but you see how the relative performance was sort of flat to down over that period because everything was rallying for the most part, rallying out of those lows, and many things even stronger. So there was a disconnect there between the price of this stock and the relative strength. And all that tells you is that there may be better opportunities elsewhere. So the way to think of it, there are two things that I would say. Number one of the best exercises you can do is look at this chart with fresh eyes. If I had new money to invest today, would I put it into this position? And if the answer is yes, then you should be very happy continuing to hold it. If the answer is no, for some reason, for example, like the relative strength is weakening, or it's becoming overbought or whatever it is, then you may want to question whether you want to still hold it. And anyways, right? I mean, if you're thinking it's not a good place for new money, should it be a place for old money in your portfolio? So thinking of it that way, not thinking of it as an existing position, do I want to keep it, but thinking of it as this is a new idea, would I feel comfortable adding here? Just reframing it that way a lot of times can help you maybe think about the evidence that you're seeing a little more clearly. And then the other thing I would say is, if you see that dispersion, that divergence with a higher price and a weaker relative, what that tells you is that other stocks are gaining more. They're just in a better position. So it might be better to look at other stocks within the group, maybe other groups, other sectors, and see if there are names that are in a better technical position and may give you better price and relative signals as well. Because again, if you own something where the relative strength is going down, you're pretty much underperforming the index. You're underperforming a passive product, and you're not really adding alpha. You're not really adding incremental returns as well as you could.
Awesome. Okay, we're going to bring up that poll, but if there was one final question, and that is, what time in the morning do you start your process?
I love it. I have talked to so many people, and I won't call out any of the hosts on the call right now, but I know some of us are morning people and some of us are not, and that's fine. I would say that to be honest, it's most important to develop a routine that you are comfortable with, that you can stick with. So, it's funny. My wife and I actually talk about our happy magic time, and hers is at night when kids are in bed. So from 10 to 11 p.m., she is a rock star, crushing things, getting it done, totally awake, ready to go. I'm a zombie. I'm a total morning person. So my alarm goes off at 6. I wake up my daughter for school, and then I try to look at charts. After meditation and journaling and other sort of self-care types of things, I try to do this morning routine. The only thing I would say then is, for anyone, this is the type of thing, this process that I've shown you should be as early as possible. Once you get in the right mindset and you can do it, I would not look at other things before you do something like this, because all this is going to do is get you primed for an awareness of what's at, of the sense of the market that you want to be paying attention to.
All right, perfect. I won't comment on schedules.
I wasn't going
to call anyone out. It's up to you.
I appreciate you not calling me out.
I leave it to you to do so, Erin, but you're welcome. So looking at the poll, this is very, very interesting. And it's funny, as I mentioned, we talked about doing this poll earlier this morning, and leading up to noon Eastern time, the markets just kept going down. And then since we started, they started to rally very quickly. But about half of the respondents are saying they could see the S&P reaching 2,700 first, which would be, at this point, 4.5-5% down, depending on where we close today. But that's not that bad of a correction, even though it's going to feel pretty bad because we've been in such a rally for the last couple months. But 2,700 is an interesting one, because that would put us below the most recent swing low, which is around 27.25. So if we get down to that level, that would be a lower low on the S&P. That would be concerning. I would be very interested to see how, what the market does, what are the characteristics, the leadership and so forth leading into that sort of scenario, because that would be very telling about, what might come next. And then, just under a third responding that we would go essentially to new highs or retest the previous high, which again isn't far away. It's about 5% up from here, but boy, getting meaningfully above that 2,800, 2,820 range would be pretty significant, and would have to be further leadership from things like technology. There would have to be, no real pullback there. And then, 20% of you saying we're in this range. What's funny is, again, if I had to pull a chart, I actually didn't vote in this. I would probably go the first choice as well. I've been relatively negative for a little while, just because of markets becoming overextended, RSI overbought, and all the divergences, Tom, that you pointed out, and that I pointed out as well with some of the smaller cap indexes and so forth. I'm seeing a lot of things that tend to happen before we see a little bit of a pullback. And I would argue going to 2,700 might be the most constructive thing the market could do, because it would make everyone feel better about meaningfully higher prices from there. But the most frustrating market is that last one, the neither, right? If we're in just this huge range and there's no real directional opportunity, I think what it will do is it means passive products don't really get you a whole lot. And if you can manage things actively and really look at the charts and identify outperformers and underperformers using some of the tools we talked about, I think you're going to be in the best position to add value. So I think there will still be stocks doing well, even in that environment, and stocks doing poorly. So the charts and the differentiation of those charts will be really, really key there.
All right, let me guess what Erin went with.
Could be anything, right?
I was joking before the program that I used to have plenty of readers call me out and say, "Oh, you're a perma bull. You're a perma bull." No, I go with the charts. I do think we're in for a pullback. I don't know that it would be, if we got to 2,700, that it would be disaster. I think that would be the point where a lot of investors who have been concerned about, the December low, they're going to see opportunity finally to not have to chase. So I think that pullback would be great, and it probably would entice a lot of people on the sidelines.
This is a tough one because I do think in the short term the market's vulnerable to some selling. I just don't know if it'll quite get back to 2,700. I think we could get a 50-day test. I think we could get those lows that we saw back on March 8th, but that's at about 2,720. So I'm kind of splitting hairs here. I don't think we go below the low that we set in March. So I believe that we're going to hit 29.40 first.
All right, then. I don't think that's a surprise to anyone out there.
We've been having this battle for a while, so I'm sure it's going to continue.
Yes.
But I do agree. I don't think it would be a horrible thing if we did go to 2,700 first. I just think that it would probably create a little bit more of a lengthy basing period before we would see new highs. So right now, I'm still looking at this as an uptrend. I think if we hold that March 8th low, I think the uptrend remains intact, and I would expect 29.40 to come. I just think if we go and break below it, it's going to start to trigger more technical selling, which I think could make the market struggle a little bit more maybe over the summer. No comment?
Sounds good. Yeah. Oh, well, I agree. I think that's a reasonable assumption too. So.
All right. So Dave, what do you think? I mean, if we break that 27.15 level and we do go down to 2,700, do you think that sets up, maybe a little bit worse for the market over the summer? I mean, here's a chart on the S&P 500. If we go back down below that 27.20, below the 50-day moving average, do you think that changes the picture for the next 3 months?
Absolutely. Because I think you're right. I mean, I think overall there's, in this sort of general bearish pattern that we've had looking back at the last, year and a half, I see that as a consolidation sort of cyclical bear experience. And, if we fail near current levels and pull back to those kind of levels down around 2,700, back down to the 200-day and such, I think that's going to be, it'll be a longer basing process. It'll be, I wouldn't imagine it goes down there and then spikes back up. I think it'll just take longer. And again, I don't think that's a bad thing from a stock picking perspective, because regardless of what the market's done, and you can see this over the last 6 months, there have been plenty of stocks making new highs and new lows in a lot of these periods. And there have been good charts and bad charts at any of these points. So I think it'll just make, security selection, stock selection more important, which I have no problem with. I think that'll be a good opportunity to differentiate yourself and find opportunities out there if you have the right process.
Yeah, and I agree with you earlier. You were saying even if we go into this sideways consolidation, there are going to be a lot of outperformers. And you pointed out the RRGs and some other different ways that you look at relative strength. And of course, we are going to be having Julius de Kempenaar on, who is the creator of the RRG charts. And it paints a really interesting picture when you look at the RRGs, in my opinion. I mean, I've really grown accustomed to these RRG charts. I really like the visualization of being able to see relative to a benchmark what some of the different areas of the market are doing and some of the individual industry groups, stocks, and so forth as you rotate on those graphs.
Absolutely.
It's true. And you'll notice, I mean, from the process that I showed you, a lot of the screens I was looking at were looking at multiple securities, and it was looking at one thing relative to other things. And if we get too much of the blinders on and we're just looking at one chart, one time frame, you can make a decision that is uninformed because you don't see how that relates to other things out there. So things like the RRG and candle glance and perf charts and things that allow you to look at things relative to one another, I think are so important to, just to see where the opportunities are going to be.
Yep. I think your chart really shows, Tom, that even if we got below 2,700, there is support there. So I think that's really would be the point where people would feel more comfortable going in. Yeah, it would break that short-term rising trend, but I think that's plenty of support.
Yeah, I think right now the reason I drew these lines in, we had kind of a straight up move off the bottom. We hesitated for a little bit. We broke out. When we pulled back, we held that area. We broke out again. We held the area initially, went up, came back down once again. It looked like we were breaking down, but we held it. And then we broke out again to a new high. I could have put another line in here.
Mm-hmm.
With a negative divergence, if we don't hold this breakout, I do think we're going to go down the 50-day, which takes us almost right to that support level. And I just think it's starting to show more signs of a little bit more technical selling if we go down and take out this level right here. So I think 27.30, maybe 27.25 is an area that I personally would be watching very closely. I agree with Dave. I think if it loses that level, I think the character of the market, the character of this rally changes a little bit as we head into summer. Anyway, but we do need to get rolling. Dave, always a pleasure to have you on the show. We've had you a couple times here now in the last week or two, which is awesome. Maybe we can get you back in another week or so. Is that possible?
Always a pleasure to join you guys. I appreciate the time and yeah, thanks so much. Have a great week.
All right. Thanks, Dave.
Yes.
All right, Erin, ready to, okay, you're
Yep.
set, ready to go.
Hey, I'm already on it. Yep,
Right.
There's the RRG for our 10 and 10. We had about 30 requests, and it was kind of all over the RRG, I thought, this day. And the technology sector, of course, and healthcare actually are the two big requests. So let's go ahead and get it started with Amc Entertainment.
All right, sounds good. I was looking at this one. I actually like the stock. Its group, Recreational Services, is not broken out above the prior high, and neither is AMC. You can see actually AMC on a relative basis was underperforming for a while, but I do like this gap up with the heavy volume. I think that it provides potential for a change of character in this chart from a downtrend back into an uptrend. I think the fact that we pulled back, we've held gap support, hit that 20-day moving average, started to turn higher. We're up today on a down day. I think all of those things are positives. And you can see off of the recent relative lows, the stock is beginning to show relative strength. Now, here's the caveat. This is a group that you can see is trading at about a 2-month relative low to the S&P 500. So a stock like this, I'm not going to have a lot of patience with if I know it's in a group that's not performing well. So I would say that I'd want to keep a fairly tight stop, maybe the 14.25. Worst case scenario, I think if it goes back and closes beneath gap support, which is down around 13.90, I would be out of it. But AMC, I think, is definitely showing signs of some leadership, and it is showing signs of strengthening here. So I'm a fan right now, but I would keep a tight leash.
All righty. Well, there actually was a tie for the most popular in the chat room, so we're going to go ahead and look at both of them. How about we start with Anthem? And the question is this a turnaround? ANTM.
Yeah, definitely is a turnaround. I love the fact, and I'm just going to pull up one spot. When I get that big gap up with earnings right here, heavy volume gap up, and it keeps going. I always talk about when you get the stock back at the top of the gap support, that's when I look for it. We had an intraday breakdown, but we came back up. We held it. Now we're strengthening. I think we're in this range between about 290 and about maybe 318, 317. And we're right in the middle of it. I like it, but I think it just continues to consolidate for now.
Okay. The other most popular was SLM, and that is, of course, SLM Holding Corp.
Yeah, this one is on my strong earnings chart list, and I like it, and it's getting close to the top of that gap support. So this is another one that I'll just quickly show right here. There is your heavy volume earnings related gap higher. We keep pushing up. Now we're working our way back down. I think as it gets closer to that 1010 area, SLM gets very interesting.
All righty, let's go ahead and take a look at SMH. And let's see where, that's the VanEck Vectors Semiconductors.
Yep. I can actually pull this up on a regular chart here. Let's go with a year chart too. So let me stretch it out. The problem I'm going to have here is going to be the same problem I have really with the overall market. And that is that in this case, we're up against resistance. But more importantly, I think we're just showing so many signs of slowing momentum that you can see a couple of highs here that have been really important over the last year. And here we are right up against it, butting heads against that wall of resistance. And we've also got higher prices. And this is what Dave was alluding to and what I've talked about. You just got negative divergences everywhere in this market right now, where you've got higher prices, lower PPOs. That does not mean by any stretch that we got a guarantee of a push to the downside coming. To me, what it means is that there's higher risk in the market. So if you're willing to take that risk and just keep riding with this market to the upside, be my guest. For me, I tend to get much more conservative when I start seeing these signs that tell me to be careful. So I think SMH, I love the semis. I think they're outperforming. They're showing some great strength and leadership in 2019. But look at how far they've come. They just it would be nice to see a little bit of a rest, and a move back down to that 100 level, I think would be awesome for the stock and for the group.
All righty. Let's see. One I'm not familiar with, an energy stock, Flowtech Industries, FTK.
Yeah, this one had the gap up. I believe that was earnings. I'm not positive. Once again, we had this series of lower lows, lower highs. I think that has now been squashed, and I think now we're starting to see some nice strength to the upside. I would simply be watching that support level. That would be one. Of course, it's all the way down $2.40. But here was your most recent breakout. That's where we gapped up with the heavy volume, consolidated, made the breakout, and look what happened when we came down and went below. All of a sudden, the buyers came right back in. We held that support area, and now we are trying to break above 350. So I would simply just get rid of this line down here now, and this is what I would be focusing on. I think you've got good support at about 285 to 290. Resistance is up closer to 350. I suspect the next breakout will be the upside.
All righty. Let's see. Next one up is HQY, Health Equity, software company.
Yeah, I think they just reported their earnings a couple of days ago. So let me see what's going on here since the earnings. Well, another negative divergence. Shocker right here. We got another stock breaking to a new high, as you can see right there. And what's the PPO? Much lower. So you've got, again, slowing momentum, slowing price momentum. So I either want to see a big volume breakout, or I'm going to be looking maybe for a test of support as that 50-day moving average moves up. So the two key areas of support are going to be the top of this gap with the heavier volume, and then the last low. So I'm going to say 70 to about 74. That's an area of support, the 50-day moving up in there as well. But with this negative divergence and today's reversing candle, if that candle sticks, I would suspect we're going to see some more weakness here in the short term.
All right, let's see. Next one, Activision Blizzard, ATVI.
All right. This one I'm still going to be struggling with a little bit. I like the volume coming in, and it's in an uptrend. I would just simply say this. It's been a laggard for a long, long time. So I would be looking at the rising 20-day. If this truly is a breakout and a resumption of a longer-term trend to the upside, it should hold this now rising 20-day moving average. The reason I've got some serious reservations is look at all the volume that came in early February after gapping down from about $48. We still have to negotiate that level, and that's the first of many levels. I could draw lines. I could draw all kinds of lines to the upside. And when you start an uptrend, obviously you got to take out one at a time, but there's a lot of supply that ATVI is going to have to try to negotiate its way through over the course of the next few weeks to a few months. And so short term, it's starting to look better, but be careful. Make sure that 20-day holds.
All right. Let's see. Next one up is Elite, ALE. It is a conventional electricity industry group.
Yeah, this one has a little bit of a momentum issue as well, but it certainly looks pretty good from a volume perspective, price volume. You can see the volume. When the volume is high, generally we're moving up. So it seems to me like there's definitely some accumulation here. Recent lows right in here have held about 81. And you can see right now we're struggling with this 20-day. I won't annotate it, but we did have higher prices. The PPO starting to roll over here a little bit. So if we fail to hold 81, I think we're going to get that 50-day test. And that would be more in line with the breakout that we saw back here at about 78, 75 or so. So I would just be watching a few of these levels. Overall, I think the stock looks pretty good. I just think the negative divergence could hamper the stock, say, over the next week or two.
All righty. How about Southwest Airlines? Love.
All right. Well, crude oil prices have certainly been on the rise here. And usually that's not a great thing for airlines and has not been a great thing for love. This was one that I thought would hold gap support, and it did not. So this is one I would certainly be on the sidelines, not really overly anxious at this point. There was your heavy volume gap up. We held around the 52.5 area, came down and really showed no support whatsoever. Well, we did bounce off 53.5 initially, but we went right back through both levels, and we're below the 20, which is below the 50. PPO's negative. We're breaking down to possibly a new closing low, or at least the last 7 or 8 weeks, a new closing low. I see some negatives here. I'm not interested in it at this point.
All righty, last one, Nokia, NOK.
All right, I saw Arthur posted recently on Nokia, and I think also on another one of the companies in that area, but he was posting, he kind of likes what's going on. And I tend to agree with him. I'm going to pull this one up on a relative chart. When you look at the telecommunications group, number one, you've got one of the strongest areas in the market. And the way you can tell is looking at it relative to the S&P 500. Here is telecommunications equipment relative to the S&P. So we're starting out with the idea that we have a very strong stock. Now, the past 7 weeks or so, you can see we've kind of downtrended, but the overall pattern has been higher. So this is one that I almost could be including in momentum sleepers, which we'll talk about here in just a couple minutes. It had strength. It's been kind of consolidating. It's still in an uptrend, but it's not exactly leading at the moment. So I would certainly say this could qualify as a momentum sleeper. Overall, I like the chart. I would simply say the recent price lows I'd want to see hold, especially being in such a strong group. So let's just look down around that 595 area. I wouldn't want to lose that area. To the upside, we've got 660 resistance. I suspect we're going to trade in this range, ultimately, though, with a breakout to the upside on Nokia.
All righty, and that does complete our 10 and 10. These are the symbols that we just went over and Tom annotated. I will have these up in the Market Watchers Live recap and on our tab. So just go to the blogs tab or articles tab, click on Market Watchers Live, and you'll find the link right there at the top. All right, we will be back after this short message.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy.
The financial sector and industry sectors. Let's go ahead. I'm going to show you, we were talking about RRG. Let's look at the relative rotation graph for the sectors. And as you can see, a lot of these are not traveling in that northeast direction, but the ones that are the financials and technology. Obviously not having the best day as far as financials go, but if you recall sector rotation, we do want to see the financials start to improve, and they sure are. They are in that leading our improving categories. See if I can talk here. As you can see, our markets right now are down for the day, with the Dow down just a little under 0.6%. Let's see if I can get our candle glance up here. Here we go. So as you can see, we started the dip back after the yesterday's top, and we are continuing lower for the S&P, NASDAQ. Looks like Russell 2000 might be making a turnaround here and forming that intraday low. We do want to see small caps start to improve if we want to look at a stronger market. See, the dollar is currently up. GLD, look at this drop. We were traveling mostly sideways yesterday. But today we're getting that big drop on GLD, currently down 45 cents. And the VIX is climbing, but it's still under 14 right now at 13.91. That's all I have for our final market update. I'm going to pass it back to you, Tom.
All right, I just want to take a real quick look at the 60-minute chart. We were talking about negative divergences on the daily chart. One of the problems I had was the S&P also had a negative divergence on its 60-minute chart. So over the past 4 or 5 days, as we've been seeing prices go higher, the PPO has not been able to get back up above the high that was established March 13th. And what I look for is a reset, a minimum of a reset of the center line on the PPO, and also a 50-hour test, and we've gotten both of those. So I think this is the first short-term test on the S&P 500. The fact that that reversal occurred yesterday, we've come back down. I think if we lose this area around, and remember 2817 was a really big resistance area trying to get back through. So if we lose that to the downside, I think that is really going to set us up for some more selling. And of course, we have the Fed coming out in 45 minutes. So let's go ahead and jump into that final segment, Erin. Momentum sleepers, what do you have?
All right, I have about 5. I pulled them up using my Momentum Sleepers scan. Mainly, I'm looking for a pop in the daily volume, the moving average of it. I like to have a close above 10. And these lines right here are really just talking about the PMO rising for the last 3 days, but on a shorter time frame scale. And this is just because I do want to catch something a little bit earlier than I normally catch. So let's go ahead, and I had quite a few results from this. I had about 28, but I want to just move on into the ones that I picked and annotated. So let's go ahead and we'll make this just a hair larger. There we go. So my first choice is Aerojet Rocketdyne. And remember, these are momentum sleepers. So we're looking for some that maybe are in the process of changing their character. We're starting to see the right signs on our indicators, despite maybe not being in the strongest setup right now, currently. So Aerojet Rocketdyne I found was a rather interesting one. And mainly I'm seeing a positive divergence here on volume. So I like to see that. I'm not really thrilled with that volume bar that we had a couple days ago. High volume on that decline, not a fan. But at this point, now that we've started to make another rise, the PMO is trying to scoop up higher. And what I wanted to point out is that typically these buy signals on Aerojet tend to be fairly successful. So at this point, I'm going to be looking for that positive crossover on the PMO, but you can see also that we have a pretty nice setup on the scooter as well. So overhead resistance at about 35.50, probably set a stop well below 32 if I were doing this a little bit longer term. Aramark was one that actually caught my eye first. Of course, now I'm looking at it and PMO is turning down. But I still think that this one might have some legs. And mainly I'm looking at the volume pattern on the OBV, rising bottoms, but flat bottoms on price. Scooter's not looking that good. But again, we're talking about momentum sleepers. Earlier, before this bar increased in its downward move here for an intraday low, I did see a double bottom here in the short term, and it still could play out. But we did hit that overhead resistance. We're coming back down. I do now see that the PMO has turned a little bit downward, but I still think this one would be worth holding on to as far as a watch list, because I think if you get that breakout, the upside potential is pretty darn good. All right, Bluebird Corp, that was my other one. And as you can see, nice short-term breakout. PMO is turned up. I think upside potential is nice here because it's about $20. So that's obviously a move you'd want to see continue. And so I like Bluebird, and there again, like I said, the PMO is starting to look pretty good here. Next one up, cars.com, and it's a similar look. We have that rounded bottom right there, and then you can see a tiny breakout above what you could consider, that trading zone, possibly a double bottom in the short term. And I think this is a really important area of resistance and hopefully support later. Look at it, lines up perfectly with the gap that we had here that needs to be closed. On the upside, that's what I'd want to see anyway. We saw it closed on the way down. You can see it lined up with some lows back here and right on those lows that we had back in May. So I also marked when our buy signals were had occurred, and they were pretty much right on. The PMO sell signals coming in under the 0 line there, and you can see up here in overbought territory, they were also pretty much right on. So I would be watching that the buy signal if we get that to come in on that breakout. And finally, my last one is C-Spine Holdings. Cup and handle in the short term. We're seeing the PMO starting to improve. If that handle part there, that little tiny handle, if that can hold on to the support level we're seeing here, or even if it just came back and tested that short-term low at about 13, looks like 80, I think that would still be good, but we might be looking at a sleeper here as the PMO is trying to make its way up for that buy signal. And again, it's always interesting to compare buy signals from before to see how successful they were. Sometimes they do come in late. But overall, in this case, if I get that buy signal, I'd be pretty happy. So what do you have for us, Tom?
All right, I'm going to take a look at some stocks that I think are kind of just sleeping right now, but maybe part of a bigger uptrend. And so when I look at these, this is biotelemetry. When I look at a stock, I'm going to be looking at stocks maybe that have started to lose a little bit of relative strength, but their group remains either in an uptrend or at least is consolidating and holding some prior lows. So here you've got medical equipment, which has continued to be very strong relative to the S&P, but you can see that BEAT has actually gone down a little bit relative to the S&P and also relative to its peers, but had been in a very strong uptrend. So I think what could be happening here is we're simply underperforming for a period of time, and then we make another push to the upside. That's what I'd be looking for. So higher highs, higher lows in play. We did have a lot of volume come in. The stock got down to about 63, but recovered to about 67 by the end of the day. I think if we can hold on to this mid-60 area, and then get back through that 20-day moving average, I think this is one that is kind of a sleeper that could begin to outperform again. So BEAT is one I certainly would continue to keep an eye on. Crocs. I've talked about this one in the past. It hasn't been a very good performer since early in January. I'm not ready to give up on it, and primarily the reason being, if I draw my price support line across at the top of that gap support, again, this is where we had the biggest volume on the chart. Buyers came in at 24. We dropped down to about 23 and then really took off from there. We got all the way up to $32. Now the stock is back down into the mid-20s with some pretty key support around that 23, 24 area. Now, Crocs, there's no doubt, has lost a ton of momentum relative to its peers in the S&P, but footwear remains very strong. So it is still part of a really good group. And when you look at it relative to footwear, it did bottom back at the beginning of March, and it's trying to move back up. I think if we get through the 20-day moving average and maybe bust through the top of this gap resistance, I think Crocs could reestablish some leadership. So this is one that I wouldn't be jumping into. I'd be waiting, but I do think it is a sleeper here. Next up, Denny's. This is in the restaurant area, and restaurants kind of fallen, kind of sitting back in the back seat right now, watching everything else do a little bit better. Here's restaurants relative to the S&P 500. So you can see it's been kind of a weak period. I've talked about this on the show a few times. After a lot of strength in the fourth quarter, relative strength, we've seen it kind of, we just have this little bit of relative pullback. I think we can turn up. Denny's, of course, underperforming the S&P and also underperforming the restaurant group. But if we break this trend line and we can start to turn back up, and I would just simply say hold, support, and I'm going to say that 17 and a half areas where I'd want to hold. Close below 17, I'd be really nervous about possibly going all the way back down to these lows. But I think if we hold 17, we could see Denny's begin to turn to the upside. All right, meat. This is the meat group. After moving up straight up on really strong volume, I think this is a stock that is consolidating As long as it continues to hold around 5.25, I think that's a level to watch pretty closely here. Internet stock's been moving up, but on a relative basis, you can see it's kind of a back and forth versus the S&P 500. Meat was a great performer that has just been pulling back on a relative basis of late. But again, if we hold that 5.25, I give this one a shot to move up. SCWX, this is one I really like quite a bit. Volume trends on SCWX, incredibly strong. Look at this breakout after sideways consolidating. Pulled all the way back, but this is the area of the breakout that we've pulled back to. I think volume trends still remain pretty good, and computer services has really strengthened off of that December low. You can see where we were in 2019. This has been a group that's actually performed pretty well, and that's enabled SCWX to outperform the S&P until the last 6 weeks or so when it's been pulling back and consolidating. But we broke out and ran up to 25. Now the stock's back down at 19 and near support. I think this one looks good, and I'd really be excited about volume picking up and getting back through that 20-day moving average. All right, SHEN, and I'm going to go ahead and make this my last one. Shenandoah Telecommunications Company. You can see, and I think this might have been a setup of yours earlier in the week, Erin, if I'm not mistaken, or maybe it was prior week.
Yes, I purchased it too.
Oh, you did?
Yes, I did.
I actually like this one. I know it had a bad day yesterday, but it's got those equal highs. I'm still looking at this as possibly an ascending triangle. I think we've come back down testing the support area, and it too is part of the global wireless telecom, basically. And I think it's done very well on a relative basis. The group has started to strengthen. It was one of the leaders in the fourth quarter of last year, had a rough January, and has started to build back up. Shentel has pulled back on a relative basis, but I think, especially if it can hold this price support area, I think that it's going to turn and make another run to the upside. So this would be one of those momentum sleepers for me as well. All right, so those are the stocks that we have covered, and let's go ahead and we'll pull up our summary slide, and then we will wrap the show up.
Absolutely.
Market's been trending down all day, and each time we get a little rally, we go down, we put in another lower low. But I really am watching the S&P 500 right now at 28.17, 28.18, which is down at that level where we broke out from.
Mm-hmm.
But there you can see on your screen the momentum sleepers that Erin and I just talked about. And I don't know, we got a minute or so. I'll bring that chart up in just a second and show you. But the highs I'm referring to are the highs that we had back in October and November, where we tried to get through 28.15, 28.20, and just weren't ever able to do it. And so let me lengthen this back to a year. But here were those reaction highs. So here's the selling, here's a bounce, more selling, another bounce up there, couldn't get through. More selling, another bounce, couldn't get through. Look at the two failures here trying to get through. And then finally we get through, but we do it with a negative divergence. I think if we have that negative divergence with a failure to hold that breakout, I think we could see some additional selling.
Yep. And I have to say, when I look at my S&P chart yesterday, the PMO topped below the signal line. So the Dow nor the S&P were able to get a buy signal out of this run, which is interesting.
Yeah. The other thing, too, is in about 31 minutes, we're going to hear from the Fed. And
yes,
it is amazing to me how many times I look at a Fed meeting coming up and the market is trading at a level that it could go either way. It's amazing how many times it happens, but we're going to find out in 30 minutes. Anyhow, I do want to thank Dave Keller for joining us again today, and thanks to all of you for being with us. Please remember to complete the survey as you exit. It's located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. We'll see you back here tomorrow. Strap on your seatbelts. We got the Fed coming up. Happy trading. Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com. with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy. Tune in to Market Watchers Live at 12 p.m. Eastern Standard Time during the week of April 1st to April 5th to help us celebrate.